All right, we are evaluating segment elimination decisions. Let's just look at what we have here before I go to the commentary. So, segments are different divisions of an organization. In this particular example, we have treadmill, wellness, and fitness. Okay, so three separate segments. Then if I look all the way down here at the bottom, I have income for the treadmill division of negative 10,000, wellness center 70,000, fitness center 35,000, and a total of 95,000. All right. So this portion of the chapter is really analyzing the treadmill division and wondering whether or not we should get rid of the treadmill division because while we have it, it's dragging us down. We are losing 10,000 a period. And so we're trying to decide whether we should get rid of it or not. So if I step back one slide, we can say that a segment is a candidate for elimination if its revenues are less than its avoidable fixed costs. And honestly, that should just be avoidable costs, both variable and fixed. Meaning, if revenue is less than its avoidable costs, then we should get rid of it because we can get rid of the revenue and we can get rid of the costs. Okay. So avoidable costs are amounts that are eliminated when the segment is eliminated. And then obviously unavoidable costs are amounts that would remain even if a segment was eliminated. Nonsense. Okay. It doesn't have to be complicated. The more obvious candidate for things to consider when it comes to costs being avoidable or unavoidable all reside within fixed costs. Remember, variable costs, for every additional unit we incur, we're going to incur more material, more labor, and more variable overhead. So obviously those costs are avoidable. But when it comes to fixed costs, sometimes they are and sometimes they're not, right? So if I have, I don't know, if I have the rent on a particular facility, what if we were to assume that this 45,000 all related to the rent on the store, right? So the treadmill division was one particular area of the store where we sold treadmills from. Now, if I got rid of all the treadmills and stopped selling treadmills, the rent that I pay on that portion of the store, it's going to remain the same. It's not going to go away. Therefore, it would be unavoidable. However, if I had a location that was only selling treadmills, and if I were to stop selling treadmills, I would no longer need that location, and therefore the rent on that location would go away if I got rid of the treadmills, then we would say that fixed cost is avoidable, right? So if I moved and shut down the store and stopped doing business out of that location, those costs are obviously avoidable. So when we're thinking about getting rid of treadmills, we really want to look at the fixed costs and really ask ourselves, what portion of that's going to go away, right? Because think about it. If I were to continue to sell treadmills and it was all in the same store, right? If I were to get rid of the treadmills, I'm going to get rid of the revenue. I'm going to get rid of the variable costs. I'm going to get rid of the contribution margin. However, I'm not going to get rid of the fixed costs. And therefore, my loss would therefore be 15,000, not just 10,000. And therefore, I think what we're saying is, in the example where fixed costs are not avoidable, we want to continue to sell treadmills because if I do sell treadmills, I'm only going to lose 10,000. If I don't sell treadmills, I'm going to lose 15,000. Okay. This next slide, right? Same concept, all right? The same concept. what we're saying is, if we go back, in the second slide, we're saying this 15,000, essentially what is happening, right? They're just going to make it slightly more complicated. What they're saying in this example is the 15,000, some of it's going to go away, and then some of it is going to get allocated to the wellness division, and some of it will get allocated to the fitness division. Okay. So they're saying that 11,000, right? So basically we have 15,000, 4,000 is avoidable. And you would never know this unless you read the notes, and I'm going to um, spare you the boring detail. So what we're saying is the 11,000 in fixed costs that will remain if we get rid of the treadmill, right? So we're saying this 15,000, 4,000 is avoidable, meaning it will go away. And then the other 11,000, the 11,000 is not going to go away. And so what we'll do is we will allocate some of it to wellness and some of it to fitness. So wellness was originally 20,000, and now I'm going to go back to the slide. And so we're going to allocate an additional 8,000 in fixed costs to wellness. And then we're going to allocate, so for the fitness, it was 10, and now we're going to allocate another 3,000. So that 11,000 in fixed costs, we're saying 8,000 is going to wellness, and 3,000 is going to fitness. Okay. However, I still think we're saying we want to continue to sell treadmills, because remember, if I sell treadmills, I'm going to lose 10,000. Okay. However, if I stop selling treadmills, right, I get rid of the revenue, get rid of the variable costs, get rid of the contribution margin, but we're saying we still have 11,000 in fixed costs that we can't get rid of. And therefore, if I get rid of treadmills and I can avoid some of the fixed costs, but not all of them, in this particular example, it still makes sense to continue to sell treadmills, even though I can't get rid of, or even though I can get rid of some of the fixed costs. This slide, this analysis up here, it's the same concept, right? What we're saying is my income selling all three is 95,000. If I were to get rid of the treadmill, allocate some of the fixed costs to wellness and fitness, my income goes down by 1,000, right? Which is this right here. I personally like this slide. Okay. Now, here's an interesting concept. Let's say that we could get rid of, I'm going to go back to this. Let's say that I could get rid of treadmill sales, and that all of the fixed costs associated with treadmill sales would go away. Meaning I could choose to sell treadmills and lose $10,000 in the treadmill division, or I could stop selling treadmills and I can save myself this $10,000 loss. Now, from a financial perspective, as it specifically relates to treadmills, I think we would say, yeah, we would want to get rid of it. However, what if it's the case that if people stopped coming into our store to buy treadmills, we would lose a lot of wellness sales and fitness sales, right? So maybe it's the case that somebody buys a treadmill, then they sign up for all of these additional services, that relate to wellness and fitness. Or maybe they buy apparel in the fitness department and sign up for classes in the wellness department. And so even though we are losing money in the treadmill division, it continues to make sense to keep it, because if we were to get rid of it, we would lose a lot of our other sales, right? A perfect example of this could be Costco, right? So, I'm a huge fast food finitia. Bleh. I don't even know how to say the fucking word. I love fast food. Make it easy. And so, like, I'm always eating fast food. I go to Costco, and man, the first thing I do is like, well, I'm getting a slice of pizza and I'm buying one of those cheap ass hot dogs. Okay, so like, I think you can get a hot dog at Costco for like fucking 2.25 or something, and it comes with a drink. I guarantee you, right? I guarantee you they're losing money on that. But if you're Costco, you're like, hey, you know what? Like, uh, we should continue to take loss on the food court because all the people that come in to buy hot dogs, man, they're spending hundreds of dollars on shit they don't actually need when they're in the store. And so, like, it makes sense for Costco to continue to serve hot dogs, right? Anyway, that is segment income and eliminating segments.